The iron butterfly collects nearly double the premium of an iron condor, yet professional traders often avoid it because of one specific risk factor: gamma explosion near expiration. Many traders treat the iron butterfly simply as an aggressive iron condor, but this is a dangerous oversimplification. While both are neutral, defined risk strategies, they require completely different management styles and market assumptions. We need to look past the max profit number to understand the true cost of that higher return. Let's start with the structural difference using the Iron Condor. You are selling a call and a put typically at the 20 to 30 delta level, creating a wide profit tent where the stock price can float freely. This structure prioritizes probability of profit over total credit received. Conversely, the iron butterfly collapses those short strikes to a single at-the-money (ATM) price point. This maximizes the extrinsic value collected because you are selling the straddle where time decay is highest. However, you sacrifice with your max profit only exists at one exact price point. The immediate allure of the butterfly is the massive credit, often covering 40% to 50% of the wing width. This creates a much smaller max loss compared to a condor, but it's a deceptive metric. The break-even points on a butterfly are much narrower than the condor, meaning you have less room for error. This brings us to the critical risk factor that separates the pros from the amateurs: gamma risk. In an iron condor, your short strikes are far away from the current price, meaning your position is relatively stable as the stock moves slightly. Your negative gamma is distributed comfortably. In an iron butterfly, your short strikes are right at the money, where gamma is at its absolute peak. This means small moves in the stock price cause massive swings in your position's delta. You are effectively balancing a bowling ball on the head of a pin. This gamma concentration dictates the management style for the butterfly. While you can often let a condor ride until expiration week, an iron butterfly demands active management if the price moves even 2% or 3%. You cannot set and forget a strategy that is this sensitive to directional moves. So, when do you choose the iron butterfly? It is the superior choice when implied volatility, IV, is exceptionally high and you expect a volatility crush, IV contraction, without a major price move. The high Vegas exposure of the butterfly benefits most from that IV drop. However, if you are trading a standard market environment where you expect the stock to drift within a range, the Iron Condor is mathematically superior. The wider break-evens give the stock room to breathe, reducing the likelihood that you will be forced to close for a loss due to a whipsaw move. Another major factor is the defense mechanism. Adjusting an Iron Condor is straightforward. You roll the untested side closer to collect more credit. Adjusting a butterfly is difficult because you are already centered. If the move happens, you are immediately underwater. Let's look at the return on capital, ROC, trap. A butterfly might show a 50% max return compared to a condor's 15%, but realized returns tell a different story. Because butterflies are closed early, often at 25% of max profit, to avoid gamma risk, the actual captured return is often similar to the condor. Therefore, use the regime filter to decide: is the market trending or consolidating? If the market is consolidating hard, use the butterfly to exploit the lack of movement. If the market is grinding with occasional spikes, the condor's width is your safety net. There is a hybrid approach pros use: the broken wing butterfly. By skipping strikes on one side, you can create a trade that is free of risk in one direction. This is often a better alternative to the standard iron butterfly if you have a slight directional bias. Ultimately, don't let the high premium of the butterfly seduce you into taking risks you don't understand. If you cannot watch the screen during the final week of the trade, the gamma risk of the butterfly will eventually hurt your portfolio. Here is your final decision checklist. Snapshot this for your next trade entry. It compares the necessary conviction level, time commitment, and volatility outlook for both strategies side by side. Remember, consistent income comes from probability management, not just selling the highest premium on the board. If you want to dive deeper into how to manage these trades when they go wrong, check out the Options Decision System playlist on screen now. Master the gamma risk before chasing the higher credit.